we're covering closed-end funds and unit investment trusts, or UITs, a critical comparison point you need to master for the Series 65 exam. Let's start with closed-end funds. The key exam concept is that a closed-end fund has a fixed number of shares. It raises capital once through an initial public offering, or IPO, and then those shares trade on an exchange just like a stock. Because they trade on the secondary market, the price is determined by supply and demand, not by the underlying value of the assets. This creates the most frequently tested concept, the premium or discount to net asset value, or NAV. The NAV is the value of all the securities in the fund's portfolio, divided by the number of shares. However, the market price can be higher or lower than the NAV. For example, a classic exam question will state that a closed-end fund has an NAV of $20 per share, but is trading on the stock exchange for $18. The question will ask you to identify this situation. Since the market price is below the NAV, the fund is trading at a discount. If it were trading at $22, it would be at a premium. The common trap is to confuse this with an open-end mutual fund, which always transacts at the NAV, plus or minus any sales charges. Closed-end funds are also subject to commissions when bought and sold, not sales charges. Now let's pivot to unit investment trusts. The two most important words for the exam are fixed and unmanaged. A UIT's portfolio is professionally selected at the outset and then it does not change. There is no active management, which means lower operating costs. Another key feature is that a UIT has a planned termination date, at which point the trust liquidates and distributes the proceeds to investors. The exam will test this distinction heavily. A question might ask which registered investment company does not have an active manager or a board of directors. The answer is the UIT. Unlike closed-end funds, UITs do not trade on the secondary market. Instead, their units are redeemable, meaning they are sold back to the trust sponsor, similar to a mutual fund. This is a crucial distinction. The exam trap is seeing the word redeemable and only thinking of mutual funds, but it applies to UITs as well. To keep these straight, here's a simple mental shortcut. Remember, closed-end funds trade on an exchange, linking the C and E. For UIT, think unmanaged investment with a termination date. This phrase hits the two defining characteristics you'll be tested on: the fixed, unmanaged portfolio and the finite lifespan. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word.com.